All right. Hi, everyone. Thank you for coming to the Stanford Blockchain Club event. So my name is Kun Peng. I'm the Vice President of Stanford Blockchain Club and also a director of the Stanford Blockchain Accelerator program. So today, it's a great honor to have actually three top-most funds, crypto funds in the crypto industry, like a16z, Dragonfly Capital, and Digital Galaxy, with the investors and partners from each of the fund to share with the student group and the Stanford blockchain community about the crypto VC. So to get started, I think I just let the panelists to introduce themselves. And one good thing is I think all three of you are alum of Stanford, studied at Stanford at some point, which is great. So I think we just whoever want to take a lead, go ahead with introduction.
Sure. Hi, everyone. Tom Schmidt. I'm a GP at Dragonfly Capital. We're a crypto venture fund, sort of split between Asia and the US. Before that, I used to lead project at 0x, which is a decentralized exchange. They build 0x API and Matcha, if you're familiar with those products. Before that, I was a PM at Instagram for about 3 years. And then before that, I did CS undergrad at Stanford.
Thank you.
I'll go next. I'm Will. I am on the investment team at Galaxy Digital in New York. I studied math at Stanford and graduated in 2019. And then I had worked in a Ethereum protocol called Foam during college. And then after graduating college, I went to work at Galaxy Digital, starting in research, and I actually built a bunch of trading software at Galaxy. So like some of the quantitative trading software. And then I kind of moved into the investment team to better align with my skill set about 15 months ago. So and that's where I am now.
Hey everyone, I'm Guy. I'm a deal partner on the investment team for the crypto fund at a16z. Focus primarily on infrastructure, the very kind of bottom level of the stack, and then on DAOs, social tokens, all of the new interesting applications of crypto that seem to have taken hold in the last year at the other end. Before joining our team, I worked at Protocol Labs for a while on their independent research team doing consensus and networking research. And before that, I was part of the startup school program that a16z ran and worked on a project called DISP for decentralized internet service provider, with the intuition being that if the goal is to build decentralized apps and something like Ethereum runs on the internet, in pretty much every country globally, it's 1 to 3 internet service providers that have unilateral control. And so spent some time trying to tackle that problem, and happy to go further down the rabbit hole there if it's interesting, but great to meet everyone.
All right, thank you for the introduction. I think next we'll go through a list of questions that we have prepared, and then probably like to 6:30, like second half, we'll open the floor for live questions. So now we'll dive into the questions. So I think one interesting aspect of this panel is we have all like top VCs actually from the crypto industry, but also like 3 different type of VCs. Like a16z, done like phenomenal job in the Web 2.0. Now is also doing great in Web 3.0. And then Dragonfly Capital is great in as a crypto native fund, and Galaxy Digital, which actually does did IPO and then actually have a venture arm investing. So it's very interesting to have like 3 different perspectives as like top crypto VCs. So my first question is, what do you guys think is like the main difference for folks? Some of the folks here who are just new to crypto, the main difference between like traditional VC and the crypto VCs.
I can start. I think there's a really obvious one actually in this particular case. There's some like a structural one which is worth discussing. A lot of the LP agreements for traditional venture funds actually restrict them from holding tokens as their direct investment. And so they are typically going to focus on equity investments, which has meant that they're either focusing on like the infrastructure plays in the space, so like that have a beta to the growth of the industry. So like those might be staking as a service providers, or nodes as a service, or exchanges custodians, and typically can't hold tokens. And then it's a mixed bag on what each LP agreement says, but there are some actual structural barriers for those funds to participate fully in the crypto ecosystem, like a a16z crypto or a Dragonfly or a Galaxy Digital has. So those are sort of the structural limitations.
I think the things that venture capital funds can do to help portfolio companies and to genuinely be a partner and just not capital are actually very different in crypto, largely because of how early crypto projects and protocols are open to the community, and how kind of the method of interaction is very different. So we have a team that focuses on engaging in the networks in which we invest with things like governance or staking. And that all happens in public, which I think is very, very different, and is also, to Will's point, a difference in market structure, where traditional venture investments today, the companies tend to go public on kind of a 10-year time frame, whereas crypto projects have some public liquid asset generally much sooner. And so that creates an interesting opportunity for people who are long-term aligned to become partners with the best projects and the best founders for kind of that 10 to 50-year time frame, when I think we can build really influential technology at kind of a societal level. And that's what we focus on.
Sorry, Kun, my Bluetooth cut out as soon as you started talking. Do you mind repeating the question?
Sure. Main question is, what's the main difference between a traditional VC and a crypto VC?
I mean, I guess, in that answer, then, echoing a lot of what, the other guy said, like, crypto is very different than you have this, it's very bottoms up and grassroots, and like a lot of times the winners are sort of driven by social consensus versus just like who has the best sales team. And I think good VCs should be able to help you like build a community, participate in governance, be an early liquidity provider, or help bootstrap whatever you're working on. But I think also like one thing I think is interesting is like it does seem like there's sort of this meme that like I think entrepreneurs find their investors very annoying, or investors in traditional companies are always like bugging them or pinging them about competitors or product ideas. And I think in crypto it's often the opposite, where pretty much everyone at Dragonfly, I think a lot of these VC funds, we've worked in the industry before, like we built companies, we've worked in product, like we've done sort of so you've seen it all. And a lot of founders are very new to the space, and so oftentimes they're looking to us for sort of advice and feedback, and they're trying to navigate crypto for the first time. And so it's sort of a different dynamic in that way as well.
See, yeah. So the next question I have is, what are some of the main or some of the interesting criteria that your VC actually use to consider whether to invest in a team that other VCs might not pay a lot of attention to? And I know like a lot of VCs say they really care about the team, but what are some other interesting metrics or criteria that you guys use?
I think it really depends on the stage. For seed stage, often the product isn't live yet even. So it is kind of about the team and making sure they're long-term aligned. They have the DNA to build what they're going to build, and they're not just sort of in crypto because it's hot, because you do see a lot of that, people who are sort of like, tourists a little bit. I think for anything, later stage, we do get very anal about on-chain metrics, looking at, okay, like what is the actual distribution of activity? Who are the kinds of people who are using this product? Are you actually getting real flows, like people who want to use this thing because they want to use it? Or is it, a lot of sort of, juiced or engaged, or sort of, not super high quality metrics? And so for us, when we're looking at later stage deals, it's really about drilling into the metrics and getting a feel of like, who are the people who are using this product, and why are they using it? And is this like, sticky or not? So.
Totally agree with what Tom said. I think the other two areas to note would be the tech itself and go to market. I think crypto probably has the fastest pipeline from genuine invention, either in industry or in academia, to users using a product that relies on that invention. And so having an understanding of how things work, I think, is very, very important and very useful to help kind of navigate the idea maze with the founder. And then I think go-to-market is significantly underrated in crypto. There was a whole several year time frame, I'd say 2017 to 2020, where everyone really had a white paper and very little product. And there wasn't that much actual effort to go and build strong communities outside of developers themselves. And I think that made some sense given the infrastructure stage we were at. But today it's I think, crucial to have a plan to get what you're building in the hands of users.
And then on our side, Galaxy's slightly different than the other two funds here because so Galaxy is a sort of broad business within crypto. We have a trading, like we have both a sort of OTC desk as well as a quantitative trading and market making arm. We've got an asset management arm that's doing passive funds. We've got a mining financing team. So we're a little more different. Like we've got a ton of business lines, and the goal of the actual investing arm, which the principal investing arm, which I'm in, is to sort of identify things a couple years out, and then give time for the other business units to align around those ideas when they become mature. So some of the criteria we really look at, or one of the criteria I think that's a little bit differentiated from Guy and Tom, is we think a lot about in what cases Galaxy can actually make a big difference in the particular either company or protocol, because we've got this big operating business. Like we can in certain ways drive growth or be the initial product, sort of like be the initial product customer. So like one of the great examples of this was like we were seed stage investors in Fireblocks because in 2017, our operations team, when we make OTC trades, the operations team settles them after the fact. And they were in 2017, 2018, using hardware wallets to send crypto assets around to other trading desks to settle trades, right? And it was so obvious when they had to like copy and paste Ethereum addresses and Bitcoin addresses and hope that they like didn't screw up. That wasn't the right way of doing things, and that just wasn't secure, keeping it in hardware wallets, and to do that at scale didn't make sense. So we were one of Fireblocks' first customers, and I think there's a world in where Galaxy can really, because we're going to be like an early investor but also an initial user, and we're going to use it every day, we can help help the companies define the product specs that they need to hit their next 10 or 100 customers, right? And help them figure out exactly what the little details of the product are that's going to make the difference for their next customer. I think that's one way Galaxy's a little different. So we kind of think, one criteria is like, can we make a huge difference in this product and help them, build this, design the actual product.
I see. Yeah, thank you for the answers. Make a lot of sense. So next question I have is token against equity, right? What's your consideration there? And what about the company that already issued equity? And also, what about there are some companies, they're crypto companies, but because of the nature of the business, they probably doesn't make sense for them to issue tokens. So what are some of the consideration there?
I'll go ahead, and I'm curious to hear Nelly and Tom. I think tokens are really useful for a decentralized network. And so if you have a network that can be owned and operated and governed by the community that participates in that, it's a great use case for a token. In terms of like the more structural financial question, I think the real issue is just alignment between founders and investors. And so we typically like to have both an equity and a token investment in the same way that the founder who owns equity and would own a token. And typically this is structured as an investment in equity with a token warrant. And I think that's generally been the best structure to align incentives. There have been a couple of cases where things can get complicated, where a team or a protocol will sell a SAFT that has some amount of tokens, and then they decide I want 2 tokens, or I don't want a token at all. I want to be an equity company. Or they sell different tokens to different investors. And this can, as you would imagine, become very complicated very quickly.
Yeah, I feel like best practices on tokens changes every year. I think as an investor, I agree with Guy. Like we just care about getting alignment between founders and investors and making sure that there aren't different classes or different tiers of people involved with the company. I think it's like we sort of saw from 2017 that, to Guy's point, like there's a lot of issues with SAFs. They're not very flexible. They don't offer traditional investor protections, and so you generally don't see SAFs these days. But traditional equity without warrants or rights can also be problematic. You see this in a lot of early investors in exchanges where they invest in the exchange equity. They don't have token rights. The exchange issues a token, but equity investors don't get that token. And then you are sort of siphoning off cash flows to the token. And so it's like you sort of create this dual class of investors and you don't have liquidity. So there's a lot of issues that way. I think for us, we don't really care if the team doesn't want to do a token. That's okay. If they want to do a token, that's okay. It's just about making sure that incentives are aligned. And I think also, making sure that tokens are done sort of thoughtfully. I think we do see people still trying to jam tokens into places where they don't quite make sense, in my opinion. And I also see, frankly, like a lot of over-engineering of tokens. I think in 2017, there was a concern that if you didn't have very sophisticated tokenomics, people would think your token, was not useful or something. I think in reality, like, a lot of the most valuable tokens are ones where there's a great product and the token sort of sits alongside it, and people will figure out the token for another day. Like Uni, for example, doesn't do anything, but people think it's very valuable because people like Uniswap. So I think it's really about building a better product, maybe using the token as a way to bootstrap into it, but you don't have to like get extremely complicated around doing some crazy tokenomic engineering kind of work.
Yeah, I mean, both Guy and Tom are making, sort of spot on what the points we would make on the token front. I mean, there's, from the investment side, there is maybe sort of like just how to compare the private market, like on the private market side, just to give people transparency, the tokens tend to trade a little higher. So tokens, so the typical structure, as Guy's referring to, is this like equity plus token warrant. And so when you're investing in equity, you're usually getting a sort of the sort of core equity group might be getting a certain percentage of the token supply. So like if the equity, if the company owns 33% of the token network or of the network, then you might own, if you're, say 10% of the equity, then you might on a pro rata basis own like 3% of the network after the fact. So the token sort of by definition trades a little higher. I think there's some strange incentives with regard to like a token versus an equity. The token investments tend not to be like, they're essentially have become like non-dilutive financing, which is structurally good for investors. I think a lot of founders, when they're raising money and they're talking about, and the value is clearly really going to be in the token and not in the equity side. They're actually selling sometimes too cheaply, because what happens in equity financings is every sequential financing is you're getting basically taking on dilution as an investor. With the token raises, you're actually typically just buying a set portion of the network when you're buying the equity. And so you don't actually, the token doesn't dilute, you buy the set portion and you hold it, and you essentially get that percentage going on. So it becomes like this really attractive, like from an incentives perspective, it becomes really attractive for an investor. And I think that's why you've seen a lot of there's tons of investors, particularly in the crypto space, who want to do the token deals, and the equity deals have become slightly less, maybe a little less attractive or more, more boring. That's not to say the companies are boring. The companies are actually super exciting, but I think there's a structural focus on token investments in the crypto space. So that's my take on it. Obviously, there's securities laws considerations with regard to all this stuff. If you're, a real centralized company and you're issuing a token, I think it's inevitable that somebody is going to come crack down on it eventually. So that's a whole separate set of considerations. But we at Galaxy, we do both at the end of the day. So yeah.
Yep, thank you for the answers. And also for the audience, if you have any question on some of the points that panelists made, feel free to throw your question to the chat, and we'll just go through the chat after when we open the floor for questions. And when we open the floor for questions, also feel free to raise your hand, unmute yourself, and ask a question there. So the next question we have is like, we're launching an accelerator program as part of the Stanford Blockchain Club, because we know that kind of crypto startup is very different. And most of the classes or accelerators associated with Stanford are more for like traditional startups. And then because of the bottom-up nature, the community nature, and the technological nature of crypto, the crypto startup is very different. So we try to become more kind of a crypto native, as crypto native as possible to help our startup incubate our startups. So what's your advice to like student founders, and also advice, but also like when to consider to fundraise, especially considering that they're right now, because of the market condition is really good, there's a lot of money around.
I mean, I think a lot of people think of fundraising the wrong way, where it's like you're fundraising to get money to hire people, or you need to have traction to raise capital. And I think in reality, especially right now, a lot of the fundraising is about like sort of finding product partners and finding strategics and finding people who are going to like help you build whatever it is that you're building. So a lot of times when we're backing teams, it's just the founder and an idea or proof of concept, and we really work with them in the very early stages to build it into reality. Like we did the Ribbon seed last year, and it was really just like an idea. Like I have friends with Julian, the founder, and we sort of talking about structured products and sort of pitched him on this idea, and we sort of did the seed with him even before it was anything, and then sort of helped him actually okay, like what is sort of the MVP here? How do we actually find liquidity? What is the actual mechanism we're going to use to like price options, blah blah blah. And so I think if anything, it's like don't feel like you need to have some crazy breakout product in order to start raising, because it's not just about getting capital, but it is, especially again in crypto, about finding people who are going to help you build your product and make it successful. I think with respect to your first question around what advice would you have for like an entrepreneur, I don't quite know what the accelerator program looks like, but I do think like ultimately what we've seen with crypto is like, even as low as the barrier to entry is for Web 2, the barrier to entry is even like lower for Web 3. I mean, we have a lot of the best teams in crypto are anonymous or outside of Silicon Valley, or very young. The Rari team, Rari Capital team, it just hit like $1 billion AUM, and they're all like 19 years old. Like really, there's nothing holding you back as long as you have a great idea and you know how to build a good product. And so I think like ultimately, the market sort of judges anything that you build. And so I just would advise getting started earlier rather than later, and like see what the market reception looks like and iterate your way onto it. Because there really isn't, I think, most of the traditional barriers to entry with respect to starting a Web 2 company.
I think from the student perspective, one really good way to get started is just to participate in some of the open protocols or DAOs. And there are so many problems, all the way ranging from very simple, build a UI, kind of a weekend hacker type project, to core fundamental research that needs invention. There's just so much to do. I think if you kind of get immersed in the world, you'll very quickly find many good ideas and paths to go down. And so I would encourage people to spend maybe less time on classwork and more time in Discord and hacking on projects on the weekend. But that's just my take.
One of the fun things about this industry as well, and particularly for students and for people who are looking to found and start projects, companies, whatever they may be, is that you're no longer does the startup like pay for their server costs anymore, right? Like if you were starting Facebook, right, you had to like raise money to scale your servers. Right now, with like when you're building on public blockchains, I mean, I'm talking about protocols here and not companies like we also invest in, but your users are now paying for your server costs functionally. They're paying for the compute, storage, bandwidth, and memory to actually use the network, right? And so they're paying via transaction fees for those services. So in some ways, it's never been like cheaper to start a project as a founder. So as you know, as these guys said, like the easiest way is just to start, particularly if you're a programmer.
One interesting plug, I don't know whether Kuhn, you're running this or Ricardo is, but we delegate tokens to the Stanford Blockchain Club. And an interesting way to get involved is to be part of the group participating in governance decisions and thinking through how the protocol should evolve. So maybe that's an avenue for people to reach out on as well.
Yeah, definitely. Actually, Tony is actually leading that effort, the DAO effort. Yeah, if you're interested, feel free to email me or Tony or Ricardo afterwards regarding DAO and governance. All right, so I have a last question before I open the floor for questions. So this is like part of the accelerator program, and a lot of students probably are looking for ideas. So the question is, since you guys live like in the forefront of the crypto frontier, so what are the things that you are excited the most right now? I know there are probably a lot of things, probably just pick 2 or 3 things that you think is going to become the next big thing that you would invest or seriously consider to invest.
I think one thing we've been thinking about a lot is, and this isn't, I'm not going to give like a particular like, idea here, but just how we're sort of thinking about how this evolves. Is, I think amongst my team, we're big believers in this like kind of multi-chain world, whether that's like multiple layer 1s or layer 1 plus several, roll-ups, layer 2s, right? Like kind of basically a constellation of different venues to conduct, transactions upon. Some venues are going to be really good at, are going to be really good for particular applications. I think where we see a lot of this going is that actually the sort of like primary point of interaction for the average user, particularly as we go into like more of a mainstream user and not like a sort of crypto prosumer that I think we see today, is that the sort of main point of interaction is going to be at the wallet level. So your user is going to like you as a user are going to have like a primary relationship with a wallet. You're not going to care so much about, oh, I'm on Ethereum or I'm on Solana or I'm on Arbitrum as a rollup. You're going to have a relationship with the wallet, and the wallet is going to basically handle provisioning like resources around these networks on your behalf. So they are going to abstract some of the sort of like multi-chain interoperability and like cross-chain message passing, but like below you. And you're going to say, so there might be a venue that's really good for payments. There might be a venue that's really good for like DAO and basically DAO organization formation and lending and borrowing, sort of like capital markets. There might be another one like a Solana that's good for like order book exchange, derivatives, etc. I think what this means in practice for us is that some of this stuff that facilitates this long-term vision, like cross-chain message passing, is super interesting for us. That's asset cross-chain assets, so stuff like Hop is super interesting, where that allows you to facilitate sort of cross-chain asset transfers. That stuff is really interesting. I mean, there's tons of protocol layer stuff that we're super bullish on and big believers in. I think like if you look at something like Aleo, introducing zero knowledge proofs to prove valid computation, forget just the privacy elements of Aleo for a second, introducing zero knowledge proofs so that you never have to re-execute a computation as a validator is like I think a transformational change on the protocol layer. Some of the stuff Lazy Ledger has done around data availability, if you guys are familiar with that, hugely important at the layer 1 like protocol layer. Obviously sharding, I don't even have to say it. Sharding and rollups on their own are we're super excited to see them come to full fruition. But that's kind of how we're thinking about the crypto world in like 5 or 10 years, and onboarding next 100 million or billion users?
Yeah, I would echo what Will said. I put a couple links in the chat. The first would just be interoperability. It's kind of crazy that we don't have an IP of blockchain, so to speak. There's no good way to make smart contract calls across smart contract platforms. And I think in a world where existing blockchains are incredibly expensive, you're really paying for security and for synchronous composability. And the opportunity to make asynchronous smart contract calls cross-chain, I think, is one avenue for really scaling blockchains to kind of a global level. I think two other interesting areas I've been spending time, the first would be governance markets. Governance today largely is a direct democracy, and there's no real way or efficient market for people to buy or sell votes. And I think there's been a lot of theory that says this is a bad thing. I would argue, and this is a longer conversation, that it's actually quite good and will enable a lot of really interesting new types of governance. So that's maybe an area to dig into. And then I would also encourage people to look into DAO tooling. I think a lot of people have talked about DAOs as being the future of LLCs or corporations. And what do corporations need that they don't have in this world for Web3? I think if you have the opportunity to spend some time there, it would be worthwhile as well. And I put a couple links in the chat if people are curious.
Yeah, I give a big plus one to DAO tooling. I think most DAOs right now are basically like a multi-sig and like snapshot, which is like not binding in any way. And so it's like, not super sophisticated, or it doesn't really live up to the vision, I think, of what both of these things are. But over time, I think with better tooling and infrastructure, we'll get there. I think for us, there's always interesting things going on. I think in the DeFi space, we're kind of getting more interested in like structured products and sort of like a meta layer on top of the sort of derivatives markets that we've seen. Like a year ago, there weren't really sophisticated or liquid futures markets or options markets in DeFi. And now we have both of those. And it's a question of like, well, what can you do with that? The same way, once you have lending market, once you have spot market, using those for margin or combining them to do other different types of things. So here's to see sort of more innovation there. I think also like we're really interested in identity. I think we've sort of seen that more and more frequently people are tying their on-chain activity to their real world identity or their sort of Web2 presence. Obviously, Twitter is like experimenting with like NFT displays right now, and it seems like more and more people are going down this line. But more looking at basically filling a way to build up someone's reputation or profile through what they do on chain. Like, are you a uni delegate? Are you voting in governance? Are you testing out these protocols from an early stage? I think there's like this whole DGen score thing that got really popular last summer, and I feel like there's more to be explored sort of in the on-chain reputation, on-chain history, on-chain identity space.
Yeah, if someone would build DGen score for NFTs, I would love you. That's like the #1 project I want to see.
I would also say on the DAO side to add, I mean, we're super in agreement on the DAO tooling thesis. I think one thing I'm personally excited for is to see the day when like a DAO finally goes from like DAOs being built to do things in crypto to the day when like somebody is like DAO actually just like using a DAO makes my life easier for starting like some like some other business, some other I think software business is probably the first place it starts, because I think you have now like these sort of decentralized like peer-to-peer get like tools like Radical, where you can sort of imagine DAOs being built around code bases. I think that's where it probably starts, but I get really excited about the day where we like cross the Rubicon essentially, and a DAO is used for something like fun. And there's plenty of examples, so don't come after me when there's specific examples. I'm really excited for the day when like it really works, and like something that would have started as a tech startup, as a company, starts as a DAO, because they can either get talent from abroad really easily. They can share incentives more easily across members of that that organization, or any number of reasons. But I think that's something we look for as like a real signal, one way or the other, that we're just excited for, I think, broadly as participants in the space.
Awesome. Thank you, Tom, Will, and the Guy for sharing so many good ideas. All right, so now we'll just open the floor for questions. I think there are some questions in the chat. So I think the first one I can see is Natalie. Do you want to just unmute yourself? And ask
Yeah,
something?
sure.
Yeah.
Thanks for all this discussion, guys. This has been really insightful and helpful from my perspective. One thing I'm thinking about, just to give you a sense for my background, I was a backend engineer at Palantir for 5 years, and I'm now an MBA 1 here at Stanford. I'm digging into DAOs a lot lately, and it's very shaky on the legal front. And I'm curious, when you're investing in DAOs or companies that want to start a DAO or have voting rights for their community, how do you think about those risks? And what do you say to startups that want to embark on that journey?
I think one thing that's interesting about DAO, I mean, there's probably a broader conversation about like regulations and stuff like that, but I will make one particular note about DAOs. That's a sort of a limitation or constraint for people who are participating in DAOs. They don't have, like, one of the good things, at least in the US, is, and in other countries as well, obviously, but is the legal like the sort of limited liability status of participants in corporations that allow participants to take risks on behalf of the company without, in most cases, there are certain cases where they do have strict liability, but without taking a risk, for themselves and risk going to jail on a personal basis. Or with regard to bankruptcies and recourse in bankruptcy. So DAOs just don't have that, like, they don't have that like status today. I think that's something that's a constraint for participants in DAOs, is like, if you have to take the legal responsibility of, if there were ever to be legal responsibility or legal recourse for the behavior of a particular DAO, and you as a participant associated with that would have to bear that responsibility, I think it becomes an obvious problem and an obvious constraint to scaling to broad use cases. I'd be curious to hear what Guy and Tom have broadly on this question as well.
I think at some point forming a DAO needs to be easier, and there should be self-serve tools for answering some of these questions. Syndicate protocol, I think, is an interesting and really useful tool here. And I know Jen, who graduated recently as well, is working there, so she might be someone to reach out to. I do think there are a lot of mitigating steps you can take on kind of the regulatory consideration, but if you don't issue a token, you don't really have as many troubles. So if you set up a multi-sig and kind of keep whatever you're doing fairly small, I think you're, again, very much not a lawyer. I am aggressively not a lawyer, but I think, you can do interesting things without introducing a lot of risk, especially at small scale when you have, a few people.
Yeah, that's also been the impression I've gotten. Also, it's always been caveated by many amount of lawyers, but I guess my kind of take on it right now is that ERC 721s and even maybe like 1155 NFTs are a little bit safer than like ERC 20 large scale token issuance. One just feels more like a collectible, one feels more like a security. But cool.
Yeah, before just to piggyback on this point in particular, the DAO, one of the few like actual sort of goings on in crypto that the SEC has like formally commented on is actually the DAO, right? The original DAO that lost a lot, and that was, they identified that was basically a security-like asset, or those assets would have been classified as securities. So you can see there's like, they already set up the legal precedent that makes it challenging on the DAO front with regard to DAOs and the Howey test. Obviously, it seems like they're saying some might make the argument that you're not relying on the efforts of a centralized third party, and that's one of the prongs of the Howey test in the case of a DAO. Obviously, they fell on the opposite side of that of that argument. So.
Yeah, I think there's a big difference between like you and your friends pooling money to go like bid on a CryptoPunk versus like you openly soliciting investment for hundreds of millions of dollars to like make a decentralized venture capital fund. Like, you know, ultimately their regulators are humans and there's not that many of them. And really what they're going after are things that are very large in scale or things that are very, you know, blatantly, you know, fraudulent or malicious. And so I do think, you know, there's degrees to it. I do think the one obviously silver bullet that we always recommend our portfolio companies do is instead of you know, issuing a fungible token, is you issue several million non-fungible tokens, and then you don't really have this concern. So that was supposed to be a joke, but I guess it's not really landing. So yeah, no. Anyway.
All right, Ipshita, do you want to just unmute yourself?
Yes, I'm sorry. Sorry, I can't turn on my video. I'm on a run around campus listening to this. But my question was that other than NFTs, what do you think about the future of media and decentralized? And so that's question number one. And question number two is, how do you think about misinformation on a decentralized social network?
We've thought about this a little bit, and so I'll take it from here. I think one of the ways, like when you talk to people at Twitter Blue Sky, for example, who are really thinking about how do you do decentralized social media, one of the conclusions that seem, and because the reality is the social media giants don't really want the burden of censoring their platforms, right? They like and actually curating the content on their platforms. It's simply too much work to do. They're held liable, like they're held responsible by governments, by, you know, like broadly held responsible, and they don't always want to be held responsible for the content of their users. I think, in my understanding, when talking with people at, you know, Twitter Blue Sky and others working on decentralized social media, the kind of consensus approach that people have fallen upon is this like open substrate for content, and then having curation happen at the client layer, so anybody can tap in, and it's a little bit like email in some ways. Anybody can tap into this open substrate for publishing content. And then the actual curation and the work to determine which content should be prioritized, you know, highlighted, recommended, happens at the margins at the client level. And then the clients would compete versus one another for users, right? And users would select certain clients based on their set of preferences and which clients they you know, they sort of align with. I think that's sort of generally regarded as one of the best practices going forward in decentralized social media. But this is such a nascent space, this in particular, that any sense of best practices at the moment is like really hard to say.
Yeah, I think I'm generally a bit skeptical of decentralized media plays, just because they generally seem to be about this story around censorship resistance, which is really only, it's very much like a tail risk issue. Like 99.9999% of people will never experience censorship concerns. And so, you know, building, it's like, oh, it's Twitter, but you get this extra, you know, 1/10,000% of like extra media or whatever. It's like, well, most people aren't really going to feel that. And you have all this additional sort of, you know, issues around performance with decentralization. I think decentralized media is interesting vis-a-vis like funding and creator monetization, where a lot of times, you know, people who are, you know, getting paid per view as a writer or getting paid per stream as an artist aren't really being properly compensated. And so I think finding ways to basically disintermediate, you know, rent seekers and get you know, consumers of content paying people directly is a lot more interesting, or finding ways to crowdfund, or finding ways to, you know, basically bootstrap those kinds of things. But I think, you know, broadly speaking, if you want, you know, decentralized, you know, social media or decentralized media with you know, curation done at the client level, it's like, you know, we had that 20 years ago with RSS. I think you know, crypto is really about building global consensus and building global state, and media is really just about read at the end of the day. It doesn't have to be sort of consensus around, you know, what is the state of this content per se.
I think there's an interesting opportunity for things like media or social networks, which I think themselves are networks, like the group of people who are really interested in Star Wars or Star Trek or Sex and the City. Fans of those projects are inherently a social community. And I think being able to tie a token to that kind of thing and say, if you were early in that community and a strong participant, you participate in some of the value capture. Like if you were one of the people who loved Iron Man far before the movie and had the opportunity to kind of participate in the cinematic universe growing over the last 15 years, I think that's a really cool model for the future of media. I think a related idea that might not be obvious is the literature behind token curated registries for things like censorship resistance on decentralized social networks. And there are a fair number of kind of fundamental results there that I think should be applied to decentralized social. And it seems like people are maybe not paying as much attention as would be prudent.
I also, on Guy's point, which is really interesting, that like these communities represent a lot of like, there's a lot of social power behind these communities that are centered around interests or whatnot. There's also a lot of economic power behind these communities as well, right? Like we're talking about, there are internet communities that have hundreds of, tens of millions or hundreds of millions of people that are either participating in them or following along actively, right? Those like 100 million people is a lot of like social, like it's an important social body, but it's also it can be an important economic body. I think this is what leads to, in some ways, the DAO. Like so part of the power of DAOs is like DAOs is the economic side of what Guy's just talking about. Like if you can get the 10 million people interested in Star Wars to coordinate economically, I mean, I think we haven't even scratched the surface of what's possible there and what we'll see. I think one thing we look at is like is Reddit's effort to build DAOs and tokens into their subreddit communities. I think that's one place that's like super exciting for the future of both DAOs, decentralized social media. But I think those two things are like the opposite sides of the same coin in some ways. It's like, how do you unlock these communities online, which already represent hundreds, tens, millions, hundreds of millions of people, and like unlock their capabilities.
Thank you so much. Just on your point around this happening at the client level, I feel like that also then is a self-selection problem, right? It's just like the RSS. People who think similarly will just self-select and be part of those networks. And that's the whole, it defeats the whole point of building that network in the first place. But I resonate with all your other points.
Yeah, I think that's a viable critique of the client, the sort of client curation model of decentralized social media. Unfortunately, there are also going to be participants who don't want to see everything that's on the open substrate sort of naturally. So yeah, I think it's unclear where this heads. You're asking, these are good questions on this topic though.
Yeah, thank you for the panelists and Deepshita for the great question. So I think next, I think Phil, you have your hands up. Do you want to unmute yourself?
Hi. Yeah, so I have two questions that probably can devolve into like really long conversations. Firstly, like I remember someone mentioning something about how it's going to be like most probably a multi-chain future. What's the rationale behind like why multi-chain instead of like maybe like an Ethereum eats all or a Solana eats all kind of like scenario? That's my first question. My second question is, what are your perspective on the future of like stable coins? Because like I've been seeing a lot of like, oh, there's like UST, an algorithmic stablecoin recently. And then now I've been just like a few weeks ago, like I've been reading up a lot of like delta neutral position backed coins like UXD and stuff like Lemma protocol and all that. Do you think, and then the SEC also says like, didn't Gary Gensler also say something like how like stablecoins are basically poker chips? So they're under regulation pressure. So do you think stablecoins have a place in that future? So those are my two questions, I guess.
I'll take the first one. I think the reason we're going to end up in a multi-chain universe is that each smart contract platform makes a set of trade-offs about things like security or scalability or decentralization. There's literally a trilemma. If you Google it, that Vitalik wrote about a number of years ago. And I would add further dimensions to that, like the programming language, the set of tools that exist for developers and for users on a given blockchain, and then even the set of partnerships or applications that exist on a blockchain, kind of the set of composable protocols. And I think there are a lot of different trade-offs you can make in that space that are valid and useful pieces of infrastructure. And that this is why I think both Will and I are really interested in interoperability, because the chance to utilize multiple different pieces of infrastructure for a single application significantly expands what developers can do at the application layer. The second question, I think, is a harder question on stablecoins. I think algorithmic stablecoins, especially under collateralized, have become kind of a holy grail within DeFi and within crypto. I don't know that any has proven the ability to remain stable during highly volatile market conditions below at least a 1-to-1 peg. And so I think an algorithmic stablecoin that is 1-to-1 capital efficient, as opposed to 150% to 1 with something like DAI, or 120% with something like Liquidity, is probably a pretty significant advancement in and of itself. There have been a lot of algorithmic stablecoins based on the seigniorage share model. And I would encourage people to, I'll put the paper in the chat, but to go back and read the original paper, because you'll keep recognizing that same pattern popping up over and over in different protocols that would suppose to be a new invention.
Yeah, so we have about 5 minutes left. I think there are 2 people raising their hand. I don't know if Will and Tom, you have a quick point to add on to Phil's point.
I think I generally agree on stablecoins. I think they're kind of a holy grail. If you just look at, like, you know, or they're like a clear sign of product market fit within crypto. Like, we use stables for funding mechanisms. People use stables just as like a bank account, especially in like emerging markets. So there's clear need for this kind of application. I don't know if the future is going to be like, you know, one bank in the US holds like, you know, hundreds of billions of dollars in you know, T-bills, and then like everybody's just trading these like IOUs around chain in like a totally KYC-less environment. I do think that is like an incredible hack that we're living in right now, and probably not going to be the future forever. So I do like to see more experimentation and research around alternate stablecoin methods that don't require, you know, pure fiat backing. But you know, it's still kind of unclear what is actually going to work at scale and be, you know, resilient and trustworthy enough to people, for people to actually you know, use for their different purposes.
All right, Junki Park, you want to just yourself?
Yeah, hey, I'm Junki. My question kind of piggybacks off Phil's, and I guess to give a little bit of background, I'm on like a very long leave of absence, and I'm working on a blockchain startup in Korea, and we focus on interoperability. And we're actually one of the companies, or one of our products is one of the protocols listed on the interoperability cross-chain link guys sent. So I don't know if I got this completely, but I think Will said you think that chains will like evolve to have like some kind of specialty, like NFTs or gaming or whatnot. We're kind of focused on interoperability in using assets for different DeFi ecosystems on different chains. And we see like a lot of growth with like a lot of different chains, like Stacks is emerging, like Celo is emerging. We all know like Solana is like getting huge. Do you think this trend will continue? And like, do you think it can continue? Yeah.
I think on this question, I think empirically we've seen the trend, right? Which is that as the sheer number of users of blockchains grows, the number of preferences represented by those users also is growing, right? And the actual amount of like venues that are required to satisfy the niche demand, like the niche growing demands of the user base is also growing. So like the case in point on this topic is the case in point on this topic is like Solana, for example, right? Particularly the main sort of advocates of Solana are these guys who came from high frequency trading, right? Where speed is the number one feature set they're interested in, or at least one of the primary feature sets they're interested in, right? And so that niche is satisfied by Solana, right? And I think we're going to continue to see, as Guy mentioned, there's a huge trade-off space that all of these blockchains represent, and certain preferences are going to be represented better by, certain sets of preferences are going to be represented by certain chains, and are going to fall, I think, are going to be good for certain applications. That's not to say they fully specialize and there's a gaming chain and a derivatives chain. There's probably going to be a lot of different stuff on each one, but I do think that you will continue to see the sort of set of preferences among the total user base of crypto users continue to expand, and I think that we'll continue to see the need for cross-chain communication on the back of that.
Yeah, thank you, Will. So we're almost out of time. Let's just give Gaurav can I ask a quick question.
Hey guys, yeah. So from a perspective of someone who's looking into DeFi and NFT as like as a potential venture that they want to build, we saw this crazy growth in DeFi last year, and now SEC is kind of catching up and regulations are kind of catching up. You guys see that DeFi is going to go through a consolidation phase and things are going to go sideways for some time, or do you guys continue to see the kind of growth going forward for DeFi?
I think there might be consolidation just in the sense that like the market has grown super quickly, but I don't think it's going to be a result of like SEC regulation. I think what we've seen is actually like certainly I think the SEC has aspirations to more aggressively regulate DeFi, but in practice what they've really been spending their time on is like really blatant fraud and older cases, and I think that is sort of better fits in their charter on like investor protection. And so certainly I do think there's you have more freedom being outside of the United States as a DeFi company, just with respect to what you can offer. It's almost more like a CFTC issue with respect to offering different types of derivatives or different types of synthetic assets or things like that, and less so around the token issuance. I think if DeFi consolidates or slows down, it's more just a function of a lack of new flows and a lack of interest and a lack of sort of new products that are serving user needs, as opposed to entrepreneurs aren't building in DeFi, or entrepreneurs are worried about building in DeFi as a result of potential SEC enforcement action, which doesn't really seem to be manifesting as many feared.
Thanks.
Awesome. Thank you. Yeah, so we're almost out of time. So just wondering if Will, Tom, and Guy, do you have like last word, parting thoughts to share with the group?
Everyone should come work in crypto. It's the best. If you're not doing it already, you should be. I'll put my email in the chat. If anyone has questions or there's anything I can do, please feel free to reach out to me. We are both hiring internally. All of our portfolio companies are hiring, and I'm happy to put you in touch with any of them if you're interested.
Yeah, I would say the same thing. Crypto's awesome. It's definitely the most fun you'll have. You'll be intellectually stimulated. It'll be rewarding. Highly recommend joining the industry. We're also hiring. We're also hiring for portfolio companies. We're also backing teams. So feel free to reach out if you want to talk more.
Yeah, echoing what you say. I mean, in some ways, the upside, the opportunity for smart young people in the space right now is really, really massive. And I think, continued, dedication as a student can get you really, really far in this industry. And don't underestimate sort of like what you can accomplish very, very quickly as a smart, and dedicated person in this space. And likewise, hiring for our portfolio companies and supporting, founders as well. So I'll also share my email.
Yeah, thank you so much, Tom, Will, and Guy, to spend time with us and share with us so many great points. Yeah, this is definitely a very exciting time. The crypto industry is growing very, very fast. So thank you so much for your time. Awesome. Bye. Thank you, everyone.